Hello and welcome. This guide is brought to you by the experts at Pro Tax Accountant, and today we are tackling a huge question for successful UK business owners. When is it the right time to switch from being a sole trader to running a limited company? We're going to break down absolutely everything you need to know. So let me ask you something. Is your business absolutely flying, but your tax bill and, well, your personal risk are growing even faster? If you're nodding along right now, then you've definitely hit a critical crossroads on your business journey. Well, that's exactly the path we're going to map out for you right now. We're going to explore the what, the why, and the how of making this crucial switch, helping you turn that hard-earned success into real security and efficiency for the future. So here's how we're going to break it all down for you. We've got 6 clear sections that'll give you the complete roadmap, from figuring out if it's the right time all the way through to your new responsibilities. Okay, let's dive right in. Okay, so first things first, why even think about making this change? I mean, let's be real, it does mean a bit more admin, right? Well, the decision usually boils down to 3 key factors that start to pop up as your business really starts to take off. These 3 reasons, protection, tax savings, and credibility, are seriously powerful motivators. But the biggest, most fundamental difference, the real game changer, is this. As a sole trader, you are the business. Your house, your car, your savings, it's all on the line. A limited company becomes its own legal person, and that one shift changes everything. All right, let's put these 2 business structures side by side. Seeing the key differences laid out this clearly is often that aha moment for so many entrepreneurs when it all just clicks into place. You can see it right away, can't you? The shift in liability and tax is huge. As a sole trader, every penny of profit is your income. As a company, the profit belongs to the company first. That distinction is the secret to protecting your personal wealth. And don't overlook that credibility column. Looking more professional can open doors to much bigger clients. This really hits home what people call the corporate veil. Think of it like this. A limited company builds a protective legal wall between your business finances and your personal life. So if the business ever gets into trouble, your personal assets are safe. For a lot of people, that peace of mind alone is worth making the switch. All right, now for the part that everyone wants to know about, the money. How you could potentially save on tax. Now stay with me here, because understanding this next bit is absolutely crucial for maximizing the amount of cash you actually take home. So that £50,000 mark, that's a really important number to keep in mind. Why? Well, for the 2025/26 tax year, once your profits as a sole trader push past about 50 grand, you get hit with that 40% higher rate income tax. Ouch. A limited company, on the other hand, gives you a much smarter way to manage your earnings. Okay, let's make this real. Forget the theory for a second. Meet Emma. She's a freelance graphic designer based in London, absolutely smashing it and making £60,000 in profit. By making the switch to a limited company, she saved around £6,000 in 1 year. That is not small change. So how on earth did she do it? It's not magic, it's all about strategy. As a company director, she could pay herself a small salary and then take the rest of her income as dividends. Now, dividends are taxed at a much lower rate because they're paid out of profits after the company has already paid its corporation tax. That combination is the key to the savings. And here it is, the pro tip, the core strategy that makes this all work. You pay yourself a salary up to the personal allowance, which is £12,570. That's totally free of income tax. And crucially, it's also low enough that you don't have to pay national insurance on it. Then you can take the rest of the profits out as dividends. This table really lays it all out, doesn't it? It's like looking at 2 different worlds. Instead of all your profit getting hit by income tax and national insurance, the company pays corporation tax first. Then you get taxed separately and far more flexibly on the money you decide to take out. Okay, so that's the why and the what, but what about the how? This is where a lot of people get a bit nervous, but honestly, it's a well-trodden path. Let's walk through it together with this clear 10-step guide. The first 5 steps are all about the setup, creating your new company and untangling it from you personally. And I really can't stress step 3 enough. Get that separate business bank account set up right away. It's non-negotiable and keeps everything clean and compliant from day 1. All right, steps 6 through 10 are all about getting compliant. This is you officially plugging your new company into the system with HMRC. Getting these steps right is so important, and it's where having an expert in your corner can save you a ton of headaches and potential fines. All right, so you've done it. You're incorporated. You now have a new hat to wear. You're not just a business owner anymore. You're a company director. And that title comes with some very real, legally binding responsibilities. And these aren't just good ideas or suggestions, they're your legal duties under the Companies Act. The big takeaway? You now have to legally act in the company's best interest, not just your own. It's a real shift in mindset as much as it is a legal requirement. Your financial year is going to have a whole new rhythm to it now, all based around these key deadlines. The ones you absolutely have to burn into your brain are those 9-month deadlines, for filing your accounts and paying your corporation tax. Miss them and you're looking at automatic penalties. No one wants that. That's not all. Here's where people often go wrong. Making the switch is exciting, but there are some common tripwires that can cost you time, stress, and money. So let's make sure you can sidestep them completely. Okay, this is the big one. The number one mistake we see people make. As a limited company, mixing your personal and business money is a huge no-no. It's actually illegal. Everything, and I mean everything, has to go through that dedicated business bank account we talked about. It's a hard and fast rule. Each of these might seem small, but they can cause massive headaches, from having your application rejected to getting slapped with unexpected tax bills and hefty fines. Now, stay with me, because this next point might actually surprise you. So, while you can save big on your overall tax bill, you do need to remember to budget for some new ongoing costs. The biggest one is usually your accountant fees. But here's the good news. That's a tax-deductible expense itself. So in a way, it helps pay for itself. You'll also have your corporation tax and some smaller annual fees, like for your confirmation statement. Okay, let's just pause for a second. We have covered a lot of ground here. Legal duties, tax strategies, deadlines, and if you're feeling a little bit overwhelmed by it all, that is completely normal. This is a huge step. And really, that's the key point. Getting professional advice isn't just about someone filling in forms for you. It's about making sure you build the right foundation for your business to grow on, and that you're avoiding all those costly mistakes right from day one. So if you're sitting there thinking, okay, this sounds like the right next step for me, and you're ready to explore it, the team at Pro Tax Accountant is here to help. You can reach out for a personalized consultation to get real clarity on your specific situation. Just get in touch via WhatsApp or phone on 07985 689 912 or drop an email to info@protaxaccountant.co.uk. And hey, for more guides just like this one, designed to help you grow their business and keep more of your hard-earned money, make sure you subscribe to the channel. Thanks so much for watching.